Companies are very concerned about their profits. For an economist, finding profit is not necessarily a simple calculation. We must differentiate between accounting profit and economic profit. We will explore that difference in this resource, defining each type of profit, which result from how we define costs and expenses. We will also explain the difference between fixed and variable costs. First, we must explain the difference between explicit and implicit costs. Explicit costs are what we would normally think about as expenses. They may result from the day-to-day operations of the firm or from a loss of value due to the resource being consumed, as happens with depreciation and amortization. In either case, explicit costs have a clear monetary value. Because they are included in the calculation of accounting profit, explicit costs are also known as accounting costs. Implicit costs do not involve a direct monetary payment, although they will be expressed in monetary amounts. Implicit costs are the actual monetary amount for an opportunity cost. They are the value an economic entity loses from making a choice. Implicit costs factor into the calculation of an economic profit, as does the explicit costs for a firm. Now that we know the difference between explicit and implicit costs, we can define accounting and economic profit. Accounting profit is the total revenue earned minus the accounting cost. Economic profit is the total revenue minus the economic cost. Simple, isn't it? Let's look at an example. Matt Maddox is a mathematician with good communication skills who spent 10 years teaching public school. While he was popular with his students, he was not a very good disciplinarian and could never get tenured. As such, he sought other avenues to use his abilities to help people learn math. He decided to open a private mathematics tutoring company. In his first year after opening, the business had $25,000 in expenses, but also made $40,000 in revenue. What was Matt's profit for the first year of his tutoring business? First, let's determine the accounting profit. This will be the profit that concerns Matt's accountant and the amount Matt will have to declare on his tax returns. The business had a revenue of $40,000. The explicit accounting expenses were $25,000. To find the accounting profit, we subtract the revenue minus the expenses, or $40,000 minus $25,000. The accounting profit for Matt Maddox's tutoring service was $15,000. But what about the economic profit? When leaving public education, Matt Maddox did not have to open his own company. Instead, he could work for various post-secondary schools, a couple of community colleges, maybe a for-profit institution, and an online state university, and make $50,000 per year. Now what would be his profit? Much of the information is the same as that required to calculate the accounting profit. The revenue is $40,000, and the explicit cost is $25,000. However, Matt chose to forego the salary he could have earned by working for the schools. That total salary of $50,000 becomes an implicit cost. Therefore, the total economic expense is $25,000 plus $50,000, or $75,000. This makes his economic profit $40,000 minus $75,000, or negative $35,000. Matt chose his career path poorly. He should stay working in the various schools. There are other ways to classify expenses. One alternate method is to differentiate between variable and fixed expenses. Variable costs depend on production. Examples of variable costs include raw materials and employee wages. As a firm produces more product, they will need more raw materials with which to build, and workers to produce the products. Fixed costs, on the other hand, do not change with production. Examples of fixed costs include the rent or mortgage for a building and insurance costs. It does not matter if a firm produces one product or thousands, they will still have to pay their rent and insure their building.